When you start working in finance, you're assumed to know a lot of knowledge. Like you're assumed to know like why central banks might matter, or what certain jargon means, or the language, as it were. And we do a lot of exams. We're trained on the products that we're selling or the things that we're having to do in our daily lives. But the most powerful thing is understanding how everything sort of connects together, and how to be really excellent at your job. Whether you're like selling something, whether you're speaking to clients, whether you're an investment advisor, whatever it may be. And so we come in and we train junior teams at some of the largest financial institutions in the world. So that's kind of what I'm doing on a daily basis, is really talking about finance from the perspective of working in the industry and how to be really, really excellent at speaking that language. I have just put together a few headlines here. If I can draw your attention to one that I think is particularly wild, is doves are scaring away the bears out in Jackson Hole. We will be able to translate this as we go through. There's also one about McNugget and a hedge fund manager, which we're also going to go through. We're going to start right from the beginning. I just want to go through a couple of basics, and then we're going to get into some juicy fun facts for your next dinner table. So what are stocks, shares, and equities? I've purposely put these all three next to each other. People honestly use them interchangeably, and I remember when I first started working, I was like, wait, is a share different to a stock, to an equity, or to a whatever? Like, they're the same thing in this context. And you'll see many headlines be like, oh yeah, people piling into equities, people shorting stocks. They're the same thing. And what are they? It's where you own a piece of a company, where you own a piece of a publicly listed company. And we're going to talk about what that is in 1 second. So you literally own it and you hope that the price goes up, right? Pop quiz. Would anybody like to have a guess what the biggest company was? Apple? Yeah. Any other guesses? Amazon?
Google.
Meta, Facebook?
BlackBerry.
You're on the right track. It's Exxon, which is an oil company, and you're on the right track with BlackBerry because it's kind of an older company that no longer in vogue. The reason I say this is because in the US and the same in the UK and over Europe, what the equity market looks like, who the biggest companies in the world are, changes over time. So back in 2010, it was ExxonMobil, Apple, Microsoft, General Electric. You've got Johnson & Johnson, you've got JP Chase. So these are like healthcare companies, banks, old oil companies. Now in 2026, it looks very, very different. We've got NVIDIA, which is this company that, by the way, used to just make graphic chips for video games, and now is the biggest company in the world. I just gave away one of those slides. And then you've got Apple, Microsoft, Amazon, etc. By the way, 2 alphabets there is not a typo. They actually have 2 different shares, and they're both huge there. Now, 2030, who knows what it could look like? This is SpaceX, a SpaceX rocket. SpaceX is the company, of course, founded by Elon Musk, who founded Tesla and is CEO of Tesla. Let's see if they IPO, if they list on the stock exchange, but it could well be, if they do, it might be the biggest IPO ever. So, how does a company become public? So this is actually me wearing the same suit in New York City. This time a week ago, on Friday last week, I got to visit the New York Stock Exchange. And so the New York Stock Exchange is one of the places where a company can list its shares to be available to the public. So if you think about a company like Ferrero, as in Ferrero Rocher, they're private. So we can't go ahead and buy Ferrero stock. We can't own it. But a company like Amazon, we can go ahead and buy the stock. And so the process by which that becomes public is called an IPO, initial public offering. And so the New York Stock Exchange, I think, was founded in like 1792, so a really, really long time ago, and it's kind of progressed a lot over the time. Another pop quiz. What is the biggest company in the world? NVIDIA, Amazon? So it is NVIDIA. But it depends what you mean by big. NVIDIA is the biggest company by what's called market capitalization. So what does that mean? It means the amount of shares of NVIDIA there are, so the amount of the piece of the pie that you can buy of NVIDIA, times by the stock price. Now, NVIDIA's value is about $4.5 trillion. By the way, a trillion, I honestly have to sometimes remind myself, is a million times a million. It's absolutely huge. So NVIDIA about $4.5 trillion. But how much money do they make? How much, like, literally sales are they making? NVIDIA is not the biggest in the world. That's Walmart. Walmart is the company that brings in the most amount of revenues, as it's called in the world. So almost $700 billion in revenue that Walmart brings in. Okay, another fun fact. So I'm sure everybody here has heard an awful lot about AI, and I don't want to talk about it like too much today, but one of the things that I think is really interesting, and is definitely a fun fact, is that in the US, in the S&P 500, so these are the 500 biggest companies in the US, 40% of that entire 500 companies, the size of it is in only 10 stocks. So if you have a huge company like NVIDIA, that is like 8% of an index, and NVIDIA moves up a little bit, guess what? The S&P 500 is probably going to move up, right? You've also got Ralph Lauren in the S&P 500. Ralph Lauren is 0.02% of the S&P. So if Ralph Lauren like goes 100 times in price, probably the S&P won't even move that much. And so this is really important because, as we've seen over the past few days, when these big companies start to come down a lot, like 10% or more, that means the overall index comes down a huge amount. So much concentration. Last one on equities. What is CapEx? So back to my friend who called me last night. Amazon reported earnings yesterday, and they reported that they are going to spend more on CapEx than had been expected, and this is basically why the stock price came down. What is CapEx? Think about CapEx like data centers. It's physical things that they're building. And all of those companies, Amazon, Microsoft, Meta, etc., are building data centers. So basically, they're spending a huge amount of money on all of this. And the size of that money is, I actually had to update the slide this morning because I had another one, but it's gone up now. So, you know, Amazon's planning to spend $200 billion, Alphabet, which is Google, $182 billion. The sum of this is more than $650 billion over the next year on data centers. The name of my company is Hawks and Doves, and I remember that when I first started working, I was quite fascinated that there's all of these, you know, animal terms in finance. Bullish and bearish are one of them, hawks and doves is another. But let's just cover what bullish and bearish means, and we're going to put it into a little bit of context as well. So bullish on the right hand side. So if I say, oh, I'm bullish that stock, means that I like it, I think it will go up. If I say I'm bearish that stock, I don't like it, I think it's going to go down. That, by the way, on the right hand side is the bull that's on Wall Street. So here are two headlines. Bullish investors pile into stocks as cash levels sink to record low. This is basically saying people are buying stocks, right? They're hoping it goes up, increase. And here we go. Bearish hedge funds suffer as equities rally. By the way, do you notice that they use, wait, where is it? They use stocks here, equities here, same thing. Bearish hedge funds suffer as equities rally. We're going to talk about what hedge funds do in a sec, but what this means is hedge funds betting that stocks are going to come down are not having a great time because equities rally. Rally means go up. What are interest rates? They're the price of money, and it's really, really important because central banks, the Bank of England, the Federal Reserve, when they move interest rates around, up, down, that impacts the value of all of our investments, impacts the value of equities, bonds, private equity, everything. And the central banks in the US are slightly more nuanced. They're trying to do two things, but central banks are trying to control inflation. Inflation is a really powerful thing because if you said, okay, 40 years ago, I'm going to start with £100,000 and we have a 2% inflation every year, meaning the price of things go up by 2% every year. At the end of 40 years, the value of that £100,000 is only 45. And to put this into a little more real context, this is what it's looked like in the United Kingdom over the past few years. One fun fact, when you hear a politician saying, prices are coming down, inflation's coming down, they would say that here. That's true, inflation has come down, but the prices are still rising, just by less than had been done before. So yes, they were rising 11% earlier, and now they're only rising 3%, but they're still up. All right, the name of my company, hawkish and dovish. These are actually really important terms because it infers what central bankers are going to do. And just like bullish and bearish, it's quite simple. So hawkish, interest rates up, dovish, interest rates down. So let's look at it in practice. So in the US, there has just been a new nomination for the leader of the central bank, the Federal Reserve, named Kevin Warsh. And the market's actually reacted quite a bit on this over the last couple of weeks. And this says, traders see Warsh as a more hawkish pick for the Fed. What does this mean? It means that Warsh might, and of course this could change very quickly, but he might be seen as being more in favor of higher interest rates. Now, he actually might be lower interest rates, but let's see, that's what the headline says at least. And this is from yesterday. So yesterday the Bank of England set their interest rates, they did nothing, they held them where they are, but dovish Bank of England holds Spurs bets on faster rate cuts, basically saying we could be seeing interest rates come down by more than had been expected, which I guess is a good thing if we're borrowing money. We're getting to the final few pieces now and getting into some of the juice. So what is an asset manager? So I worked for an asset manager before I started Hawks and Doves. And I always like to think about, if you go to this is Greece, an island called Paros. And if you've ever been to an island in Greece or anywhere really, there's just tons of restaurants around, right? And you can choose all the different restaurants to go to. And this is the analogy I like to use when I think about asset managers. So an asset manager's job is to take our money and invest it somehow. But we don't get to pick and choose, like if we had like a private chef to say, okay, this bit, this bit, this bit. No, we go into the restaurant, which is the asset manager, and then we choose the dish that we want to have from that asset manager. Now, some of them could be really specialized in whatever it may be, but others could have a massive suite of different things. And so it's like you get to choose which restaurant you go into, you choose which dish you invest into, and that's their dish, the chef's specialty, rather than you going and saying, oh, I want that, but I don't want this, I don't want that. I mean, that does sometimes happen, but generally speaking. I want to give you a fun tidbit from probably the most famous investor in the world. So pop quiz here. What is the first rule of investing according to Warren Buffett?
Not losing money.
And what's rule number 2?
Compounding.
I think that's like rule number 3. Rule number 2 is don't forget rule number 1. So you're absolutely right. Okay, so why does he say this? Why do we not want to lose money? So if I had £100 and I lose 50%, I have £50, right? How much percentage do I need to gain to get back to where I started? So if I gain 50% on £50, that is £75. Okay, I'm not back to where I started, right? If you lose 50% of your money, you have to double it here to get back to where you started. And so the whole idea is like, really don't lose money, because it's really hard to kind of get back up to where you had started from. If you lose 70%, by the way, you've got to get 233% to get back to where you are.
But Morgan, thank you so much. That was so informative, even for those of us that live in finance. Hugely appreciate it. Thank you.